Hello, and welcome to our third quarter strategy review. We met actually last week when it was only rumored that it was going to be the hottest day of the year. And now we're recording this, and it is the hottest day of the year. So I guess some people do predict things accurately. And hopefully, we kind of predict some things accurately as well, and have over the years. But at any rate, with me at the meeting, we had again a guest who was very, very helpful, especially in the bond area, Andy Luckel of Eagle Harbor Asset Management, and then Len Skeena, CEO of the firm, and Bob Toomey, Vice President and Head of the Research. In any case, we, as I say, met. We did review a great deal of material, as we always do, but we found that there was a great unanimity of thinking that assets, equities still continued to look positive. The amount of funds that are available for purchase of equities still appeared to be quite positive. And there was a concern, continued concern about inflation, which actually caused us to pull only our fourth trigger in company history. And that happened mid-quarter because inflation did start running a bit higher than we thought it would. But in any case, I think I'm getting ahead of us. So right now I'm going to switch it to Bob to talk about US equities. Bob?
Thanks, Dan. So I think that's a good opening preamble, if you will. I think the outlook for U.S. equities continues to be positive in our view. This is based primarily on the data we're seeing from the economy, the reopening from the COVID-induced recession is continuing. The data that we look at, things like employment, consumer spending, industrial production, and industrial related indices all continue to look strong. And this is again supporting a positive outlook for the economy and also a positive outlook for corporate earnings. And as you've heard us mention before, corporate earnings are the key driver for stock prices over the long term. There are certainly other influences on stock prices, such as interest rates, Fed policy, geopolitical events that all have an impact on valuation. But the primary driver of stock prices is corporate profit. And we think that continues to look good for the next several quarters. What I've been seeing is a number of the research resources we follow are continuing to raise their estimates for S&P 500 earnings for both this year and next year, which is positive. There are a couple of risks that I think are notable that we did address at the meeting. One of those is the issue of valuation. And if you look at certain measures of valuation, such as price to sales, and also the level of margin debt as a relative to the value of the index, such as the Wilshire 5000, we're seeing some valuation measures that do appear quite high. And that has us concerned a little bit. But you've heard me mention this concern in the past, and the market right now seems to be looking through that. The other concern right now, of course, is inflation. And the inflation that we're seeing in the US, I believe, and we believe, I can discuss this at the meeting, we believe that the inflation we're seeing now is transitory, and it's largely due to the severe disruptions we've seen in supply of all kinds of products in many industries as a result of the COVID-induced shutdowns. We think that within the next 3 or 4 quarters, we believe the supply disruptions should begin to normalize, and that the inflation data that is going to look high for the next several months should start to moderate. And as a result, we continue to feel fairly sanguine about US equities at this time. And we will continue to monitor this data that we feel could have an impact on our investment strategy in your portfolios. With that, I'm going to turn it over to Len to talk a little bit about international equities.
Thank you, Bob. The US is slightly ahead of the rest of the world with respect to vaccination at this point, significantly ahead of some of the emerging markets, but even ahead of other developed nations at this point. Nonetheless, we do anticipate those areas continuing to vaccinate their citizens. We're expecting to see those areas continuing to recover economically as they do. And for that reason, we're not really making a lot of changes to our international holdings. At this point, we're still overweighted from a normal allocation in the international area. We still like the international area, just not quite as much as the US area right now, but we do like the international area, and we like the emerging markets fund that we've been using, which is, if you recall, an emerging markets fund that excludes state-owned enterprises, because history has shown that the state-owned enterprises do not end up having as great a return as the more private enterprises do. And so the fund that we're using excludes those state-owned enterprises and actually is, giving us a little bit of additional jolt to that part of the portfolio. With that, I'm going to turn it over to Stan to talk about REITs.
Thanks, Len. Once again, we looked at the REITs, and we found that there were many, many pluses that continue in the REITs, not the least of which are a higher rate of dividends being paid because of the pass-through nature, remembering that REITs must distribute 90% of their income. And that has always made it a very strong feature of REIT investing. However, we have been a bit concerned about the fact that REITs do invest in large office buildings. REITs also invest in large shopping centers, and REITs, of course, invest in large apartment buildings. We favor, and we again emphasize, the large apartment building section, because as the current trend of, in effect, having evictions being postponed are starting to change, and therefore we feel strongly that people that run large residential types of properties will probably benefit, as some of these people who were not able to or not paying rent will be converted into rent-paying tenants. So we have once again emphasized that section of the REIT portfolio by buying a particular REIT which invests almost exclusively in large apartment buildings. But again, REITs continue to be favorable in our view. The overall real estate investing appears to be favorable. So consequently, we are once again maintaining a very full investment in the REIT sector. Again, emphasis in large apartment buildings, because we think that's where there'll be some initial benefit of seeing those non-rent paying sections become rent paying once again. With that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. On the fixed income side, it's an area that we actually spent a fair amount of time in the meeting talking about. Again, as Bob mentioned earlier, we do anticipate there will be some inflation in the next few quarters. And while this inflation is occurring, interest rates tend to rise. And with rising rates, bond prices tend to go down. So we are trying to position the portfolio for this rising rate environment, even though the Fed has made it clear that they would prefer not to raise rates right away. At some point, their hands may end up being tied to the point where they have to do something. And, they're going to be walking a fine line between trying to promote economic expansion as much as possible without allowing inflation to have it overheat. It doesn't appear to be the kind of inflation that is going to cause things to overheat. And so from that standpoint, we're not really worried about it from a long-term perspective. But nevertheless, we are looking at how it's going to affect the bond market. We are skewing things towards the shorter duration at this point, towards the short end of the curve, with the understanding that the longer end gets impacted much more severely as interest rates rise. We did make a significant change in the intermediate term area, where we were holding a global international bond fund, and we replaced that now with a fund that invests in senior loans. Now, senior loans are loans that are issued by banks to corporations to fund operations and business expenses and expansion and things like that for these corporations. And they tend to be floating rate loans, which means that as interest rates rise, their coupons are going to be adjusted. And that's going to actually allow them to be much less interest rate sensitive in terms of the prices, and therefore protect you should interest rates go up with respect to the valuations of your holdings. That particular holding is actually giving us a yield whereby we're not really losing hardly anything from where we were with respect to the international fund that we were holding prior to this, but we are getting much better protection with respect to interest rate sensitivity. On the long end of the curve, we are continuing to hold, in addition to treasuries, a position in preferred stock. And that position in preferred stock is again there to provide some additional yield and to hopefully protect against some interest rate fluctuation. With that, I'd like to turn it over to Bob to talk about some changes in our model.
Thanks, Len. Great overview of our fixed income holdings and discussion on that. I just going to make a couple of brief comments about some of our holdings in the equity area, the U.S. equity area, particularly in the area of commodities. We added a new position in the natural resource commodity area. It's the SPDR Exploration and Production ETF. It's the XOP, which is involved in, again, primarily oil and natural gas exploration and production. We did that because we want to emphasize this sector largely for a couple of reasons. One, because with an expanding economy coming out of this deep recession, we think that demand for fossil-related fuels will be rising. And also, oil is used in a wide variety of manufacturing industries, particularly in plastics and things like that. So as the economy continues to expand globally, there will be higher demand for oil. And we think that, combined with what we expect will be limited production, we believe is going to result in further increases in oil prices. So we wanted to try to take advantage of that through this addition of the XOP. We also continue to hold in the mid-cap area a position in the SPDR metals and mining ETF, the XME. We believe that as a result of the expanding global economy, as we think there will be continued upward pressure on demand for metals and industrial metals prices, and we think that holding should continue to benefit from that particular trend going forward. We also continue to hold a position in MOAT, which is the WisdomTree wide moat ETF in the large cap area. We continue to like this very much because we believe that it's the one ETF that I know of that actually has a very much of a human element involved in deciding which stocks are held in that ETF. Every holding in Moat has to have a buy rating by one of the Morningstar analysts that follow the sectors that these stocks are held in. And I like that because it gives some element of human judgment and not just sort of a computer-based algorithm that is sorting out a bunch of stocks and then putting them into an ETF. So the ETF tends to have an emphasis on value. It has done extremely well, has outperformed the S&P over its 13 or 14-year history, and we think continues to be an excellent holding in the large cap area, focused both on value primarily. We think it gives us great exposure in the value sector, which we think is an important area of emphasis right now in your portfolios. So with that, I'll turn it back to Stan for closing comments.
Thanks, Bob. And thanks to all of you for listening to our presentation. As you can see, we continue to be quite positive, even though markets are hitting new all-time highs. The S&P 500 last week, many stocks are hitting new all-time highs. And you might question, why are we so positive? And one of the reasons is consumer confidence. And consumer confidence is something that we are watching closely. And actually, there is a chart that you will see coming up. We have used consumer confidence as a trigger in the past, and we are again, frankly. But consumer confidence is strong and rising. And our trigger would be if that changed. So again, we are not expecting it because we don't expect things to happen that like that. Otherwise, we wouldn't be as confident as we are. But that is something that we will be keeping an eye on. And you can keep an eye on it as well. If consumer confidence did start to wane, we would definitely make some adjustment. But again, we're not anticipating it. In the meantime, as I mentioned, we are recording on the hottest day of the year. I can only hope for all of us in the Pacific Northwest that when we record again, it won't be the hottest of anything and we'll get back to normal. Hope you tune in next time. Thanks again for listening.